Hi guys, good evening to you. I believe you are doing well. Right, so I promised to record a video on other blocks, and I have done just that, or I'm doing just that. Okay, so we are going to talk about other blocks. They work hand in hand with forever gaps, so we'll treat all of them together. I believe that after this, any analysis that I'll do with you, you will understand it better. Okay. Let's go deep into it. So we want to look at order blocks first. So order blocks are specified. So we shorten it by OB. So if I send you an analysis and you see OB, I'm referring to order block. And the order is like asking someone to do something or charging them to do something. It's not like choosing between something like options. No, not that's order. I mean order blocks. Okay. They um they are specified or specific price zones representing institutional buys and then sells. So normally where the market makers would pick their trades. Okay. And it is identified as the last opposing candle before a sharp impulsive move. So by last opposing candle, we mean that if the market is buying, the last bullish candle before the sells, okay, that is the other block. Okay. So before every sharp or impulsive move or displacement, there is an order block. Okay. There is an order block. So normally when you see an impulsive move, go and check it well. You may see another block there. That's basically it. And often it breaks the market structure. Most of the time, it breaks the market structure. By that, we mean that if it is in a downtrend, it will break the most immediate lower low. Or if it is in an uptrend, it will break the most immediate higher high. That's basically it. Okay, so this is just the theory. Now, this is how it looks like. So you see that over here, you are seeing green candle, which means the market was propelling upwards. And then all of a sudden, we have red candles taking over, or bears taking over the market. So before the sell takes place, the last bullish candle before the sell, that forms the order block. So you see that shaded the entire candle, the entire bullish candle here. Okay, that is the order block. And the opposite is for um bearish order block. So it means that we have a bullish order block and a bearish order block. So in a sell market, the last bearish candle before the strong impulsive buys, that forms what the buy order block. So this is a sell order block and this is what a buy order block, or bearish order block and bullish order block. Basically, it's so key aspects of what order blocks. So identification. This is how you can easily spot it. So look for a consolidation area followed by a strong impulsive move that creates a fair value gap. I will talk about fair value gap in this lecture so you will understand it better. But then let's break it down. So sometimes you see that when the market is in a predominant buy trend, all of a sudden it will change direction and then it sells. And then the last bullish candle forms the sell order block or the bearish order block. Sometimes too, the market will consolidate, but as it is consolidating, all of a sudden you see a strong impulsive move, okay, or displacement that forms the order block. Another criteria is that it has to create a fair value gap. Now, it's not every order block that creates a fair value gap. Let's establish that. It's not every order block that creates a fair value gap. However, if it creates a fair value gap, then you know that it is valid. If it creates a fair value gap, then you know it is valid. By the end of my lecture, you understand it. And we have two types. I think I've already mentioned. We have bullish order blocks. So the final bearish candle before a strong bullish trend. That's what a bullish order block. And then a bearish order block, the final bullish candle before a strong bearish trend. That is what a bearish order block. I want to believe this is easy, right? Now, um, let's see other aspects of it. So validation rules. Now, high quality order blocks generally cause a break of market structure. Okay, So most of them, see, you say high quality, it means that not all other blocks will end up breaking market structure, but the high quality ones, the most valid ones, often breaks market structure. Okay, or there will be a change of character. There will be a change of character. Okay, well, I think I will explain this better to you, and then are often unmitigated. That means that price has not visited them yet. So for high quality order blocks, we want to expect that it has broken market structure or it has caused a change in character, and that market has not visited the zone. That's a high quality order block. By that, we don't mean that when the market has visited an order block, it is invalid. The probability of it playing out has reduced, but it is still valid. You understand that? Okay, so mitigation. Price often returns to these zones to mitigate it or close out institutional position before continuing in the new direction. Let me break it down. When you identify an order block, be sure that market will come back to the block before it will continue the move. So if it's an uptrend and then you find a bullish order block, you expect that the market will sell back into the block and then the buys will continue. This is not always going to happen, but when you draw another block, that's your expectation. You understand that? And because market hasn't visited that block yet, we say that the block is not mitigated. Okay. But then the moment it visits the block, it has mitigated the block. It has tested or retested the block. So you should be careful when it comes back again. Now, how do we trade another block? So first identify the zone, identify the last candle before the impulsive move that breaks the structure. Okay. Wait for it to return. Like I said, we will look at the what do you call it, the practical aspects. Okay. So when you identify the other block, wait for the market to return to the block. Okay. And then you look for confirmation signals, your entry signals. So we've talked about that. You can use the candlestick confirmation. Okay, now you have to set a stop loss, and the stop loss is usually below the order block or above it, depending on whether it's a buy order block or a sell order block. And then you have to also set a take profit. You'll see how we do that. Now, let's see some of the things that invalidate the order block. So if it happens that a candle fully closes beyond the boundaries of the block, the order block becomes invalid. So we are saying that when a candle penetrates the order block and then it closes above it with a strong body candle, not just a wick. If it's a wick, it is likely it is a liquidity sweep, but a full body candle will make it invalid. We'll try and see if we will spot some of them. Okay. And then multiple taps. When the market visits the order block for more than 3 times, the likelihood that it will not play out again on the fourth time is very high. So when the market tests the block for multiple times, you should be careful. And then weak displacement. So you see that the market was buying, it changed to a sell, but that sell was not an impulsive move. Search other blocks. They are other blocks, all right, but may not be valid. Okay, they may not be valid. So if you trade them, you are very likely to lose in that trade. That's basically it. Now let's add fair value gap to it and then move forward. Okay, so a fair value gap is a three candle. Right, so let's talk about fair value gaps. Yeah. So a fair value gap or FVG, okay, is the three candlestick pattern indicating a price imbalance where rapid high momentum movement leaves an unfilled gap between the wicks of the first and third candles. Now, these are just fancy words. Okay, let's break it down. Remember, we mentioned that another block is formed as a result of what? A sudden change in momentum. So let's say the market was going up and all of a sudden it changes direction and then it goes down, right? Most of the time, you are very likely to see three continuous bearish candles. Okay, these candles are called, or these candles form what we call a fair value gap. Now, there are some criteria that it must meet. Okay, the first candle and then the second candle, they shouldn't overlap. their tips or their wicks must not overlap. By overlapping, we mean that the prices shouldn't cross at any point. If it happens, it is not a fair value gap. Then most of the time, the middle candle is bigger than the first and the second candle. Most of the time, it's like that. Okay, the middle candle is bigger than the first and then the second candle. Well, for a perfect fair value gap, you want to see that in a bearish trend, it is giving you three continuous bearish candles, and then in a bullish trend, it's giving you two continuous bullish candles. Okay, sometimes this can be a bearish candle or this can be a bullish candle. It doesn't really matter so long as we have the middle candle being bigger than the two and that the tips of the first and the second candle are not overlapping, we say that this was a fair value gap. Now, this is what we call the fair value gap. The gap between the tip of the first candle and then the second candle. That is the fair value gap. Remember, we said something here about what? Imbalance. It means that the market has created an imbalance here and it must come back to fill it. That's basically it. So it has left a gap behind, and we expect that the market will come back to fill that gap. All right, now let's proceed. Okay, so key aspects of a fair value gap: three candlestick structures formed by a large impulsive middle candle that moves too quickly, leaving a space between the high of the first candle and the low of what? The third candle, vice versa. Now, market inefficiency. The gap represents a mixing piece where supply and demand were unbalanced, resulting in little or no trading activity at those price levels. So, like I said, there is an imbalance. Okay, the market has left a gap, a void behind. It has to come back and fill it. That's basically it. Okay, so magnet effect. This is how it works. Because these areas represent inefficiency, price tends to return to these levels, or the market attracts it to itself. So, acting as a magnet for future or retesting action. So those gaps, they serve as or act like magnets. They pull the market to itself. So you are very likely to see that when the fair value gap is left behind, the market will be pulled back to it. Okay. Then time frame, while this visible on any chart, you can see fair value gap on any time frame. Same for the other blocks. Okay, you can see other blocks on any time frame. FVGs on higher time frames, like 1 hour, 4 hours, daily, are generally considered more significant, often used by institutional traders. Yeah, so other blocks and fair value gap, they form on any time frame. Um, 30 minutes, 15 minutes, 5 minutes, and what have you. But we are saying that the ones on 1 hour, 4 hours, and then the daily candle are very significant. So remember, when we were doing the analysis, we started from the daily, then we looked for another block on H4. Do you remember that? Yes, it's coming from here. Okay, so we have to see something and a fair value gap on H4 or another block on H4 because we know market is likely to come back to this. Okay, so there are two types, just like the other blocks. We have bullish fair value gaps and then bearish fair value gaps. So for bullish fair value gaps, it occurs during strong upward momentum, where the high of the first candle is lower than the low of the third candle, leaving a gap below. You will get this better when I do an illustration. So let's skip this part. How to treat fair value gap. So you identify the gap, look for three candles such that the middle is bigger than the first and the second, and that the tip of the first and the third are not overlapping. It's very important. The tips shouldn't overlap. The moment they overlap, it doesn't count. Okay. Wait for revisit. After you have identified it, wait for the market to come back to the gap. Then you take your trade from there. Entry strategy. A common entry point is upon the price touching the edge of the gap, aiming for it to fill the gap before reversing. Okay. Yeah, so that is just it. And risk management, always set a stop loss just beyond the outer edge of the first or the third candle. Okay, so it depends whether it's an uptrend or a downtrend. I'll show you all of this. Okay, so at least now you have a fair idea about what other blocks and things like that. Yeah, this, I mean, this one was theory. So let's go to the chart and see if we can apply both the order block and then the fair value gap. It is very important. Let me show on recording. All right, great. So we have Euro USD chart on my screen at the moment. So let us try to see if we can identify. So we are going to identify order blocks and fair value gaps. We are going to identify order blocks, sorry, order blocks and fair value gaps. Okay, so this one often we use OB and then this we use FDG. Okay, right. So after this, like I've said, I want to believe that you will understand every analysis that I will do with you because I use this in almost every strategy that I used to trade. Okay. So let's try to see this is what the 1 hour time frame on Euro USD. And I'm seeing a lot of other blocks and a lot of fair value gaps. Okay, I'm seeing a lot of them. So let's see. Let's see if we can identify another block. Now I'll start from here. I want to start from this part of the chart. So let's see something. You see, we have an upward move from here. Okay. In fact, before anything, this is another block. This is another block. It is another block. So you see that we were selling, right? And all of a sudden, boom, we have price, okay, going all the way to the top. So this gave us what an impulsive move. So the opposing candle before the impulsive move, which is the bearish candle, forms the other block. So this is the ideally we should expect that when the market trades on this onto this, it gives us a buy. So we expected that to buy from here. Okay, there is a reason why this didn't play out. I will explain it later in the course of our lesson. So it is not every other block that is going to play out. Just bear it in mind. It's not every other block. It's not every fair value that is going to play out. All right. Now let me delete this. I have some other blocks down here I want us to look at. Let's look at this. Yeah. Let's look at this. We had price going to the top, then coming down here, and all of a sudden we had this big buy move here. So we should look for an order block because there has been an impulsive move. So let's see the last bearish candle before this strong buy is what? This candle is this one. So what we do is that we are going to trace this to the right and then we zoom all the way here. Okay, we zoom all the way here. Now look at how beautiful it is. So by the time we marked this one, okay, only this side has happened. Okay, so we were waiting for price to do whatever it will do. Okay, we were waiting for price to do whatever it will do. Okay, and then come back to the zone. That's all we were waiting for. Just let's look at it. Just beautiful. See, boom, all the way to the top. So if you had seen this, if you had seen this other blog, Charlie, you would have made a lot of money. You would have made crazy sum of money. Let's look at this. I want to calculate it for you. I want you to see what you missed because you didn't know this. All right. So let's say I want to enter there and assuming I took my TP at this level. We have about what's the difference? Okay. Prices. So the entry is 1.1451. I want to do it manually so you see it calculator. Sorry. Calc. Okay. So now let's do it. 1.14. What was it? 5 1. 5 1. And then minus my TP, let's say here 1.1624. 1.1624. Um, so it should be the other way around. Okay. It should be the other way around so that you have a positive value. So we have 173 pips. We have 173 pips. Now let's see how much that would have made us. So I mean we have our final value. Okay, so our final value is 173. Now let's see how much that would have made us. If you use the standard lots, which means that one pip is what equal to $10. You multiply this by $10, and then how much is that? That gives you $1,730. So if you have used 1.0 on this trade, you would have on this trade, if you have used 1.0, you would have made $1,730. Let's say you don't have the money, so you use 0.1, which is $1 per what do you call it? 173 times one, and that's going to give you $173. So 0.1 would have given you that. And the 0.01, the least would have given you $17.3. That's the beauty. You get a point. Very, very simple. Okay, so that's a lot of money. This would give you a lot of money. In fact, that number is also here. This is the difference is here. You see, we have 1.173. You see the difference there. So you multiply that by the lot size you are using, and that tells you how much you have made. Just imagine someone that has a lot of money and that they are trading with 10 lot size. That is $100 per pip. The person is going home with so $17,300. Yeah, so if you understand fair value gaps, that's you would have made a lot of money. Now let's see something interesting. I'm going to clear this, okay, and see something that happened. Look at here. Okay, so again, I want to explain this side. You see, we consolidated over here for a while. Price tried to push up, and then when it got here, we had this deep drop all the way to the bottom. So before this mighty sell, there was an opposite candle, which is the bullish candle that brought about the sell. And see the beauty. If you had gotten, let me take this off so that my chart will be clear enough for you to understand what I'm trying to say. So if you had caught this, look at it. If you had caught this buy, you know there is a beautiful order block waiting for you here, and then you would have gotten this sell as well. See, just look at it, beautiful. It's just too simple. I just like this, what I'm seeing. It's beautiful. So try to understand this. It is not difficult at all. So I've shown you other blocks and I've shown you buy other block and then sell other block. Now let's try to see fair value gaps. Let's try to identify fair value gaps. There are numerous of them on the chart at the moment. There are a lot of them on the chart at the moment, but I want to show you one from here. So always, the easiest way to identify them is to identify a strong body candle or a big body candle. So look at this candle. Okay, this candle. You see that we have one here and then another one. Then the tips are not overlapping. So it means that the whole of this space is of a fair value gap. The whole of this space forms a fair value gap. Now, I want to distinguish between them. So I want to bring OB so that you know that this is what another block. And then this is also OB. But then what we have here is an FVG. This is an FVG. Okay. This is a fair value gap. I'm talking about this candle. And just look at it. You see that market traded into it and then the sell still continued. And it played out even here. You see, it dropped all the way here, went back into the gap, and boom, it sold. You get a point. Very, very beautiful. It's very beautiful. So if you understand what you are doing. Okay, these things are very easy. Remember the key aspect of order block. You mentioned something like during the consolidation, when you see a strong impulsive move, so we had market consolidating here, and then there was a strong impulsive move. It means that we have an order block here, and that led to this fair value gap. Okay, it led to this fair value gap. So there is an order block right here. So which candle brought about this sell? So we want to identify the last bullish candle that brought about this sell. So I would want to identify this one and then I'll put it here. Look at it. So you see that market went to that other block and then it sold. So if another block followed by a fair value gap, the fair value gap has to break the structure break of market structure. It happened here. So this is the valid order block. You see market trading into it. And then, so you can use the idea of market trading into the block, and then you pick the entry, or market trading into the fair value gap, and then you pick the entry. So what I tell my students is always check the risk. The one that is okay for you, then you take it. So if you feel like the fair value gap is okay, then you can take it. If it is not, then you can wait for the order block. Personally, I trade the order blocks a lot. I trade that a lot. Not like I don't trade fair value gaps at all. In fact, I have analysis using fair value gaps, but I trade the other blocks a lot. You see the beauty. Now let me take you somewhere. See, let's see something beautiful. Now we are going to identify a big candle. We have this beautiful candle here, right? The tips of the first and the third are not overlapping. You see them here, they are not crossing. And we have this mighty body here. We know that when price trades into this is what we have established, that this is a fair value gap. This is a fair value gap. So when price trades into the fair value gap, it should sell, and that is what is happening. So because of the bank holiday, we didn't have any move today. Okay, and even yesterday. Yeah, so that's just it. We are expecting that it will trade back into the block. Okay, that's just it. So that's how to identify them. So we are done with this side. Let's try and see if we will see we will identify some more over here. Hmm. So I want to believe you are getting the concept now. So all of you that were confused, I'm sure we've been able to clear your confusion for now. Okay, we've been able to clear the confusion for now. Now, let me show you something. Look at this. You see there is a buy here, and then all of a sudden, market changed, or market changed, it started dropping from this side. Okay, but then you can see that when it started dropping, it wasn't with what strong momentum. This one, it wasn't with strong momentum. These candles, not strong momentum. So we will not consider this as a favor, another block. Now let's observe this side. Price was selling, beautiful. Look at this, very beautiful. Then it came here, and the last bearish candle before the upward move gave us a strong bullish candle, another strong bullish candle before we went up there. So this is a clean order block. So when market came back to this OB, you could have taken a buy from here with your target here, because remember, this is also an order block. Look at it, a bullish candle preceding a bearish trend. Now this is a strong a high momentum candle. We have some here as well, although it's messed up in the middle, but you can see that this bearish candle is more like this is a continuation of this one, right? Yeah, so we have a momentum here. So you could have taken beautiful a buy from here, then right into the block, you are gone. You leave that and then see the sell. Look at it. Boom. There was a break, a market break here. And then just look at the sell. Just beautiful. Very, very beautiful. So this block, this order block, bringing about this mighty sell. Okay, this order block bringing about this mighty sell. We want a fair value gap so we can jump on the trade. We have this candle. This one is bigger than this. The tip of this is not overlapping. So we have what? A fair value gap right here. And let's look at what happens. So we have FVG. Look at it. Price traded deep back into the fair value gap and the sell continued. The sell continued. So we will use this in line with what we have studied. After we have identified a trend, we have zoomed to maybe H4, then we identify some of these things, these other blocks of fair value gaps, and then we can expect price to come back to this zone and we find our entries from there. I want to believe this is very simple, not just simple. I want everyone to understand it. So leave your questions under this video in the comment section and I will address them. Okay. If you are new to my channel, I will just urge you to subscribe to my channel, share the video for others to also enjoy. Today we are talking about order blocks and fair value gaps. Since we'll be using them in most of our analysis, we want everyone to understand it before we go deep into the analysis. Okay. So there are a lot of them forming, a lot of them forming in the market. So just look at the criteria and then if it meets it, then you trade that. Okay. Then you trade it. Mm. So we have a lot of them forming in the market. Right. So let's see the synthetic indices if we can find them here as well. Other blocks, fair value gaps, they work everywhere. Every market that you come across, you will see them. Okay, you will see them. So just have to know what you are doing, then you'll be good to go. All right. So let's see. I want to, there is this market that I posted yesterday. I want us to look at it again. Okay, so this market right from here is in a beautiful downtrend. It's in a beautiful downtrend. However, markets failed to create another low, and then it went on to change character at this point. It went on to change character over here. Okay, went on to change character here. So, and then went on to create a new high, telling us that the market has switched direction. Okay, it has switched direction. So from here, we should expect it to buy more. We should expect it to buy more. Now let's see something interesting that happened. Now, you see we have strong bullish, two strong bullish candles going up there. And then we have that the tip of this is not overlapping with this. So we have this here. I'm talking about this. So there is this fair value gap here, right? So yesterday, I think I posted this should be in the Telegram channel. I posted a buy on this chart. This is where it is coming from. Okay, so noticed that price has traded back into the fair value gap. It has traded back into the fair value gap. Now over here, because it was consolidating, this was not a proper test. It has come back to it. So this is what a clean test, and I expect market to push further. I expect it to push further. Like I said, we have this um in the Telegram group. Yes, I have this in the Telegram channel. Okay, so that is it. On the daily time frame, we have been able to identify this. We are not going to trade from here. What do we have to do? From what we learned today, we have to go to the lower time frame and let's see something interesting here. Now we have an order block on H4. Okay, I'm going to give this a different color. Yeah, I'm going to give this is the fair value gap coming from the daily time frame. So we have FDG. This is the 24H FVG. And then we have the 4 4R OB. Okay. Now we can expect price to trade back here and then we take our buys. This will be sorry. This will be a very good buy. The price will trade back here. Then we take our buy. This will be a crazy buy. This one to be a crazy buy. If we should have this condition, it will be serious, right? Now there is a fair value gap here. By now, I'm sure you can easily identify that we have three candles. The tips are not overlapping, so there is a fair value gap here. This may hold the buy off from getting to the OB. So if you like, you can take the buy when it gets to the fair value gap. Some of us we will still want to wait for it in the order block. If it comes here, Charlie, we will enter. Then we have this beautiful order block here. I want to believe that all of us are on the same page, right? Beautiful order block here. So at least we are buying all the way to this level. And then we will expect it to drop for a while. And then if it breaks it, the buy will continue. But this is the expectation. This is the expectation. I think I like this analysis. So share it in my group. Telegram. Yeah, I'll share it there. Okay, so I want to believe that at this point you understand how to identify an order block, how to identify a fair value gap. This is how I trade. Okay, this is how I trade. So there's a long position. I will expect it to come here with my stop loss here and my TP all the way up here. So I'm doing 1:10. And if I get this right, this should give me, the difference is huge. This will give me a lot of money. Yeah, this should give me a lot of money. And if I don't win this trade, how much am I going to lose? Just a few, just some few pips. Just some few pips here. Remember, if you want to break it down further, when it trades back into this block, you can go to 15 minutes to see. Let's see if we will have that. Let's see if we'll have let's maybe a fair value gap within the or another block in the yeah, there is one. Yeah, there is one on the 15 minutes time frame. Let me clear this one so I don't confuse you. Remember, consolidation, the last candle that precedes the momentum. Remember that we said that. So even in the H4, we have broken it further. So some of us would want to take the trade in the 15 minutes time frame. And trust me, this is crazy. This one is crazy. If you are to get this trade, say you enter here, you put your stop below this, and then if you are to target the same points, let's see, let's look at it. If you had to target the same point, look at it. That's the beauty of trading on the lower time frame. You see the risk to reward ratio. This is powerful. And so let me go on to answer the question that Mrs. Jane asked in class. You see, are we going to hold this all the way to the top? Now, this 24 hours, let's see. Let's look at it again. The 24 hours, okay, this will take a while to finish. This will take a while to finish. And not many of us can hold this all the way here. So you can be targeting maybe some H4 candle high, some 24-hour candle high, some 8 hour candle high for your target. You can be targeting those one. Okay, when you hit it, you are out. Then you wait for the market to give you another opportunity and then you take it again. So, yeah, I want to believe this is clear enough and that we have understood the concept of order blocks and fair value gap. Just look at it over here, the 24 hours, we have a fair value gap here. So, this one, when the market trades and guest here expected to sell for a while. Yes, expected to sell for a while. Mm, expected to sell for a while. So we are very likely to see something like price going here and then maybe resuming the sell. Remember, we are still in a sell. Like overall, like the overall trend is what a sell. This one, only that market is changing direction from here, but this is it. So if you understand some of these things, you know where price is likely to be attracted to, and then you take your trades from there. If you have any question, like I said, leave it in the comment section. I will do another video to explain it. Okay, if you are new here, make sure you subscribe. Okay, make sure you subscribe to my YouTube channel. Also share this video with your trader friends. Let them take advantage of this education, this materials you are providing here. And then again, we are trading with dairy broker, right? If you don't have an account with us, there's always my IB link will always be in the video description. Just make sure you tap on it, sign up an account, and then enjoy, because we will be providing a lot of what analysis setups on what the synthetic indices, which is only offered by Deriv. Okay, so if you have an account with that, you get to benefit from that as well. All right, sure. We have a Telegram channel that we normally share our setups and our signals there. Yeah, so I think I downloaded. Oh, okay. So I have to log in again. Okay. All right. So I'm going to share the setup I did. I'm going to share it in my group. Yeah. So there's a Telegram channel that you can always join. The link to that channel will also be in the video description. Okay. So you can join the channel. Thank you so much. We will continue with the lesson. We're going to do more advanced and crazy analysis. And I believe that by the end of the whole process, you should understand this and understand it better. Thank you.